Hello and welcome to the LSL webinar. We are just going to take a couple minutes for everyone to filter in, but welcome. We're just going to get started in a couple minutes. Thank you everyone for coming. We're just going to leave a minute or two for everyone to filter into the webinar, but thank you for coming to our LSL webinar. We're so excited to have you. Awesome. Well, as people start filtering in, welcome to the LSL webinar. I'm going to go ahead and get started. Hello, everyone, and welcome to the Back to Basics series webinar, Lighten Your Year-End Load, Tackle Accounts Payable, Accrued Liabilities, and Long-Term Debt Reconciliations with Ease. We are glad to have you with us today. Before I introduce our presenters, a few housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording, as well as a copy of the slides and resources. This webinar will run for 50 minutes with a 10-minute Q&A. If you have any questions for our speakers, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and a toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation. To receive credit, you must answer 3 of the 4 polling questions and also complete the short evaluation you will receive afterwards. The evaluation email will be coming from Prolera. If you have any trouble seeing the polls, try minimizing the Zoom screen. Sometimes the poll question box pops up behind it. You may need to click around and drag the Zoom screen to see it. If you are using multiple screens, check each one as it may pop up behind another screen. If that does not work, you will need to disable your pop-ups. All right, now I would like to introduce our speakers. Monica Fernandez is a supervisor in LSL's Consulting and Advisory Department. Monica has actively participated in developing requirements alongside information systems and has a keen eye for identifying and implementing process improvements. She excels in evaluating and enhancing user requirements, providing comprehensive user training, and ensuring compliance with established policies and procedures. Additionally, she is skilled in handling complex accounting transactions, such as debt refunding, grant compliance, reporting, and project management. Jamie Lambert is a manager in LSL's Assurance and Advisory Department. Jamie oversees municipal, water districts, special districts, and not-for-profit audits. He manages the audit engagements and completes technical reviews of financial statements. He has an abundance of experience assisting in the preparation of the annual Comprehensive Financial ACFR report, performing analytical and substantive audit procedures on account balances, and planning the nature, timing, and extent of procedures involved in the audit process. He often assists clients with the preparation and review of GASB 68, 75, and 84 journal entries, and the review of capital assets, debt service, federal and state award schedules. And behind the scenes is Ryan Domino, partner in Assurance and Advisory. He will be answering your questions through the Q&A, so feel free to put your questions in the Q&A box throughout the presentation. And now I'll hand it over to Jamie and Monica. Take it away.
Thank you so much, Cami. I appreciate that introduction. As she said, I'm Jamie Lambert. I'm a manager here at LSL, and I'm going to get us started talking about the objectives for today. We're going to learn about the challenges faced by governmental agencies related to debt, accounts payable, and other liabilities, and how to address those. We're going to discuss approaches to reconciling debt and AP each year, and discuss payroll and benefits accruals and the changes to compensated absences coming with GASB 101. I did want to note ahead of time that pensions, OPEB, leases, and SPIDAs kind of fall into this bracket, but we have previously had webinars about those. So if you would, we're not going to be addressing those today. If you want further information about those, please go back and watch those webinars. And that'll bring us to our first polling question. As Cami mentioned, please make sure you're answering all the polling questions so you can get credit for your CPA for today. Are you ready for the fiscal year 24 audit season? I know I am, and I'm sure everyone else is as well, right? And as you're answering that, we're going to go ahead and move forward, and I'll turn it over to Monica.
Okay, and we're going to start with long-term debt. Let's start by going over the different types of long-term debt. We have general obligation debt, which is normally, an example would be municipal bonds that are often issued to finance public projects like schools, parks, and infrastructure improvements. Revenue debt, which is secured by specific revenues. An example would be water revenues to finance water revenue bonds. There are also special assessment debt that are secured by assessments for road improvements and also sewer bonds. And other lines of debt are lines of credit, promissory notes, loans, and financing agreements. Also, within financing agreements, you'll see things like lease purchase agreements, not to be confused with your GASB 87 leases. These are actually financing agreements where you're actually purchasing the asset. I'm going to go over a roll forward example. And in this example, here we have the answers to our polling question. It looks like we have a lot of, well, everyone looks definitely ready. I love it. Okay. That's good news to our auditors, right? Okay, we'll go back to our roll forward example. As you'll notice on this example, we have on our long-term debt schedule, we have a bond, a note, and loans payable, notes payable, the right to use liabilities, which is your GASB 87, SPIDAs, GASB 96, and compensated absences. All these items should show up should be reported on your roll forward. Today, of course, we're just focusing on bonds, loans, notes payable, financing agreements, and compensated absences. As you can see, we'll just go column by column. You're going to have your beginning balance. So your beginning balance, you want to match your ending balance of your ACFR, your prior year ACFR. You want to have an additions column for any new debt that was funded during the year, and your deletions column, which is any principal payments that you made during the year, which will get you to your ending balance, which should match your general ledger. We also want to have a column for the principal that's due within 1 year. So on your debt schedules, you want to look at the principal payment that's due in the next fiscal year and put that here in your principal due within 1 year column. I also like to have the interest paid just to make sure that you've recorded the interest correctly for each of your debt agreements. And then we also have the accrued interest column. And this is, we're going to discuss this a little further. This is your interest that is due in the next fiscal year, but for the portion that relates to the fiscal year under audit. And of course, we just always want to have a column for your balance per general ledger so that you can ensure that your balance matches. Your general ledger matches your roll forward work paper. So let's discuss debt entries. Debt proceeds should be recorded in the funds designated by the debt agreement. So if, for instance, if your water fund is financing a bond, a water revenue bond, you want to make sure that that is recorded in that specific fund. You may also have some deferred charges on refunding, and that should be recorded in the same manner as you receive the proceeds. And as payments become due, your debt expense should be recorded. I think we're driving home, should be recorded in the same fund. If there's any, sometimes you're going to have where the general fund might cover another fund's debt obligation. This should be done by transfers. And the principal and interest expense should be recorded again in the same fund that the bond or the loan was initially the proceeds were funded for. Deferred charges on refunding. This occurs when the new debt is issued to refund old debt. You don't always have deferred charges on refunding, but when you do, we're going to go over an example of how that is recorded. When debt is issued, you should always receive a closing memo, and that's the example there with the sources and uses of funds. This gives you all the information you need to record your debt accurately. On this slide, there's an example here of how to calculate the deferred amount on the refunding. And so this will be available for your reference. Okay, and then, okay, so we're going to go into the interest, the accrued interest payable calculation. Normally, most debt, your payments are due March 1st, September 1st. Not always. Sometimes we see it April and October. It can be various months, but in generally speaking, we normally see payments due March 1st, September 1st. So for this example, the 6-month period that we're paying on 9/1 includes March 1st through June 30th. And so we want to capture that interest that's due in the fiscal year that is under audit. And we do this by, we normally do it by using the days calculation to come up with the interest accrual. So we use the days from the last payment through the end of the fiscal year, which is the 121 days, and the total days, which is the number of days between the last interest payment and the next interest payment on September 1st. You can also use number of months. This will get you close to the interest accrual, the same interest accrual. So either method will work. Another important topic is the debt covenants that are within your debt agreements. Very important to know what your debt agreements say about and what your debt covenants are. It's important to read through your indentures. If you are unsure, definitely reach out to your trustee if you have any questions or not understanding what the debt covenants are. They're normally embedded within the indenture. So, but it's important to understand the different types of accounts that your agreement or that your trustee has open for you and what the requirements are. So make debt compliance part of your monthly checklist. So as you're doing your entries, make sure that each month you know what your covenant is that you need to follow, and check that off. Covenants usually are yearly and sometimes even every 5 years. So it's just important just to make it part of your checklist so it's not missed in any year. And your audit request list, your PBC list that you receive from your auditor, should not be a reminder to start reviewing your debt covenants. At that point, it's probably a little too late, and you've missed complying with your debt covenant. So some examples of debt covenant requirements. The most common, of course, is the cash reserve. And And sometimes you'll have an insurance policy in lieu of the cash reserve. And another one would be an amount equal to the percentage of the debt proceeds. Sometimes it's all dependent on, they want you to have an amount in your accounts that covers the amount of the debt or a percentage of the debt proceeds, or it could also be a percentage of revenues. So there are many various types of covenants. So it's important to understand within each agreement which, if you have debt covenants, and add that onto your checklist. Okay, polling question number 2. Is your government in compliance with all its debt covenants?
All right. Thank you very much, Monica. So that brings us on to how this information gets audited. And specifically, we're talking about the debt in this portion. So first, we'll talk about what information is needed for the audit. And what we'll request is your debt roll forward. We'll want to get your evidence of compliance with your debt covenants. So any information you have about your debt covenants and what you're doing to comply with that. We'll want documentation of any debt that may have been added during the fiscal year, including the agreements and any entries related to those. We'll want the amortization schedules for that new debt as well, including any premiums, discounts, and any deferred charges on refunding. And additionally, we'll want your calculations prepared and the entries that you recorded for the new debt, because we will go back and recalculate those. We'll want the initial debt proceed entry and any calculations related to deferred charges on refunding, which I just said. And how does that get audited? Well, what we will do is we'll confirm new debt. We may confirm other debt instruments as well, particularly if you have completed the debt or finished the debt instrument in the year. We'll probably confirm that one. We'll trace your principal payments to the general ledger, and we'll agree the current and long-term amounts to your amortization schedules. And just to go back real quick, apologize for flashing through there. As the roll forward that Monica shared, I think is a great roll forward example. And what we'll do is we'll go line by line, column by column. We'll agree the beginning balance to your prior year ACFR. Next, we'll go through the additions column and verify that all of the new debt has been included in your additions. Then we'll tie the deletions back to your general ledger, and along with the additions, we'll verify that you have recorded those proceeds to your ledger as well. Next, we'll tie the deletions back to your general ledger and agree that. And then we'll test your estimate of principal due within 1 year. Usually, we're hoping that ties to your amortization schedule. And then we will also perform a recalculation of your accrued interest. And it's helpful, like in this example, the roll forward includes a balance or a tie out to the general ledger. As auditors, it's helpful for us if that's included, and also the trial balance account number is included with that as well. It helps us, it helps us as auditors to better agree that information. Monica also shared this information here, and when we talk about recalculating your interest accrual, this is the calculation we kind of use. We go by the number of days, but obviously we're looking for reasonableness. So if you use a month calculation, that's going to be reasonable. It's not going to be far off from what we did, and we're probably not going to ding you for that. Additionally, for the testing of the debt covenant and your debt covenant compliance, we'll confirm any reserve accounts. We'll ask you for any verification of the existence of insurance companies, policies you might need in lieu of reserves, and then we'll run ratios or any other kind of test we need to do for any other type of covenants you might have. And again, there's a variety of different covenants that could be out there. So, we'll just base it off of what your agreements say, and we'll run our test based on that. Another thing we will do is for new debt, we will go back and recalculate your entry and rerun your entry. We'll test your entry, make sure that we agree with it. If you had to come up with any deferred charges on refunding calculations, we'll rerun those and verify that we agree with those as well. And what I would say is, as you get new debt, it's, you can provide that information to us before year end, before we're asking for it for the audit. You can go ahead and run that by your auditor, and we'll be happy to look at that, even before we're in the audit period, and tell you whether or not we agree with what you came up with, and if your entries are correct. And I'll hand it back over to Monica for the accounts payable.
And we're going to discuss accounts payable, payroll liabilities, and other liabilities. Accounts payable, I think we all, figured it's pretty straightforward. But we do want to just emphasize a couple things at fiscal year end. So we want to make sure to capture the expenditures that apply to the fiscal year that are under audit and that are expected to be paid in the next fiscal year, or after the end of the fiscal year will close. So you should review payments made after the fiscal year, all the payments made after the fiscal year, to determine if the services were rendered within the fiscal year under audit. And reviewing these payments should continue through the end of the audit. Normally, cities will have, or municipalities will have cutoff. Normally it's 2 months after the close, but it still should continue through the end of the audit, in that something material may come through to be paid, and that will need to be accrued back to the fiscal year that is under audit. So that's important to remember and to know. And you want to prepare a reconciliation. You want to reconcile the accounts payable GL account to the subledger, the aging or the outstanding invoice report. And then I'm going to show you an example of a reconciliation that I've done. And as you can tell, this is all the AP by fund, and it compares it to the outstanding invoices, the subledger by fund. And this ensures that you've captured all the AP and it's accurately in the correct funds. And then next, we're going to discuss payroll liabilities. So we're going to start with accrued salaries, and we want to make, of course, we want to make the accrued payroll calculation, which is you're going to use the first payroll of the new fiscal year, and you want to capture the number of days that relate to the prior fiscal year. In this example, I used a city with the fiscal year end of September 30, and their first pay date in the new year is October 12, which is covering the pay period of September 26th through October 9th. So we want to capture those days, September 26th through September 30. We want to accrue those back to the fiscal year under audit. And then I'm going to show you an example calculation, and simple calculation just done by fund using the gross payroll and the number of days calculation to come down to get the total accrued payroll that relates to the prior fiscal year or the fiscal year under audit. And the next topic is going to be your accrued benefits. Accrued benefits can get a little more complicated in that you usually have many different vendors, many different types of benefits payable. You want to complete reconciliations monthly for benefits payables. That ensures that the payments to the vendors and the deductions are recorded to the correct GL accounts. You want to make sure that the payments are not missed, or you make duplicate payments in error, and that the deductions also gives you deductions are in line with the payments. As you know, when you have employees separating and onboarding, and there's going to be timing differences when they're added and when you're billed for those particular employees. And at fiscal year end, you want to determine if there are any accruals needed for payments made in the new fiscal year that relate back to the fiscal year under audit. And again, you want to look for prepaids. Sometimes some of these benefits are prepaid, and you want to make sure that you reclass those prepaid benefit payments to prepaid expense, reversing in the new fiscal year. That way you capture the expense in the correct period. And then this is an example of an accrued benefits reconciliation. As you can see, all the various different types of benefits, the account numbers, and as you can tell with this schedule, there were payments applied to the wrong account, so there had to be reclasses done, and we were able to easily identify the reclasses that needed to be done because we've done the reconciliation and compared it to the deduction register. And so I think this is a good example of how to do a reconciliation for benefits, accrued benefits. And then in our next topic, other liabilities. Other liabilities are due to other governments, and these are usually accounts payable due to other governments for taxes collected for another government entity, retention payable, which are related to CIP projects where the city will hold a percentage of a bill from a contractor to be paid at the end of the project at acceptance. Once it's accepted, then that retention is then paid. Deposits payable for customer deposits and developer deposits. And it's important to keep good record and track of these deposits and retention payable so that you're making timely payments and you have accurate knowledge of what your liabilities are, and that customers and developers are being and also your vendors are being repaid back in a timely manner. And I think, is that it? Are we going to go to your audit, how this gets audited?
All right. Thank you, Monica. So I'm going to go through each of these sections individually. First, we're going to talk about what information is needed for the audit of accounts payable. And so what we will do is we'll request any scheduled reconciliations as of the fiscal year end for accounts payable. But we would want that to include the information related to the vendor, like the vendor name and things like that. If you just give us a list with check numbers and maybe invoice numbers, that might not always be helpful for us to select a sample. We're also going to request any cash disbursements from the fiscal year end date through the audit field work. And that should include all forms of payment, checks, wire, Venmo, whatever else your government is using. And we're going to request the open encumbrance PO rollover report as of the fiscal year end as well. Now, what we'll do with that information, so first we'll review your accounts payable aging report for reasonableness. We want to make sure that, honestly, if there's any stale AP, I guess the question would be, do you really owe that amount? Or why haven't you paid that amount already? There shouldn't be really old AP on your aging report. And if there is, hopefully there's a good reason for that. And then we will also perform a test called the search for unrecorded liabilities. We'll select the sample from the cash disbursement ledger that I mentioned that we would be requesting. And then we will, from that sample, we'll verify that, we'll test to make sure that your AP aging is complete. We want to make sure that any cash disbursements after the year end are either included on the AP aging if they belong to the prior fiscal year, or are not included if they should have been on the current fiscal year after audit. Additionally, we'll look through you will look at your open encumbrance and PO report and identify any stale or open encumbrances or POs that should be closed. For payroll liabilities, we'll request payroll registers for pay periods in the fiscal year under audit that had paid disbursements after the year under audit. And Monica mentioned some examples of those, or some other examples here. And we'll also look through the AP style payments for other payroll related liabilities like retirement, insurance plans, OPEB, and taxes. Additionally, in the payroll liabilities, we usually test, this is where we usually do test OPEB and pensions. But as we stated, we had a previous webinar about that. So if you would like more, we're not going to go into deep detail into those in this one. What we'll do is we'll recalculate the payroll accrual based on the final payroll registers for the year. And Monica kind of touched on that. And then we'll also calculate payroll-related ratios such as payroll taxes to total payroll and compare that to prior year ratios to determine reasonableness. Large fluctuations from one year to the next may warrant further investigation. In this section, we'll also, test your census data and things like that for your pensions and OPEB. But again, we're not really going deep into that on this webinar. For other liabilities, we'll look at your schedule of your amounts due for the other governments. We'll ask for grant agreements, any legal statutes related to taxes collected for other governments, contracts and things like that. We'll look at your schedule of deposits payable. We'll want to know the purpose of those deposits and any contracts related to those or any other agreements. And then your schedules of retentions payable. Provide any relevant invoices that agree to the retentions amount. And we'll also want any agreements related to those as well. And the way we'll test that information for the amounts due to other governments, we will trace those to the amount recorded on the general ledger and compare that to the documentation provided just to verify that the amounts agree. We'll agree the amounts of the deposits payable to relevant deposit schedules and agreements to verify the deposits are still valid and the payable should still exist. And then we'll trace your schedules of your retention amounts to the relevant CIP invoices and ongoing construction projects to verify that you're not holding out retention payable for things that might have already been accepted or completed. And that's going to bring us on to our third polling question, and just a little, just a little backstory here. I live in the state of Alabama, so hopefully you all are familiar with college football, as familiar as we are, and you know that the best college football team, I said the best, the polling question seems to say the favorite, but that's okay. Either way, same answer. The University of Alabama Crimson Tide is the best football team and should be your favorite as well. Anyway, all right. So as that polling question's going on, I already see some people saying they're not going to answer that polling question. So I apologize, but roll. All right. And now we're going to move on to compensated absences. And I'll be taking it from here. USC, huh? It is rigged. I'm loving the comments. All right. Only a couple more weeks, y'all, and then we get, college football season in full effect. I can't wait. Maybe y'all are more about pro football, but I'm all about the college. So there you go. Anyway, all right. So with compensated absences, we have to talk first about, fiscal year 24, which is currently under GASB 16. And then we'll also talk about a little bit about GASB 101, which is in effect for fiscal year 25. So you're welcome to early implement GASB 101 if you want, but there's no requirement to do so. So first we'll talk about GASB 16. With GASB 16, the threshold recognizes probable. So any accrued time that is paid at termination is what you would accrue with your compensated absences at the end of the fiscal year. The major change here is that GASB 101 requires us to factor in the amount of time that can be used. So they've lowered the threshold, and this is again for fiscal year 25 and forward. They've lowered the threshold to recognize a liability that is more likely than not, as opposed to probable. So, you're going to need to make an assessment to support the percentage of employees in the non-vesting population as well as your vesting population. So, we're going to be accruing for amounts that we're not guaranteed to pay out when a person terminates. You're going to have to determine how much your employees will be using through the course of their employment with you, as opposed to just how much will be paid out, most likely be paid out at termination. All right, so for recognition and measurement, we're going to go over kind of both here. You'll need the rate of pay in effect as the balance sheet date, and that should be what you use to calculate your liability. There's no requirement to estimate how much somebody might be making in the future. This is true for both, GASB 16, what we're currently under, and GASB 101. You'll need to, for GASB 101, include salary-related payments as part of the liability. So that would include the employer's share of the payroll taxes, as well as any required contributions to defined contribution plans. So what we mean by that is, 401k style plans or 457B style plans. Those required employer payments, not the employee payments, need to be included in your compensated absences calculation moving forward. That doesn't include pensions, just to say that. Just the 401k, 457 type plans. Other changes, and this is mostly for the disclosure purposes, GASB 101 allows disclosure of net change only instead of increases and decreases. So if you'll remember back to the debt roll forward that Monica shared, currently for compensated absences, we need to disclose additions and deletions for the compensated absences. Well, with GASB 101 moving forward, we don't need to do that. Additionally, we will no longer need to disclose which funds are used to liquidate the balances. So, currently you have to identify, like, maybe it's being paid out of the general fund, and that needs to be included in your disclosures. Well, they're removing that portion of the disclosure moving forward. All right, so we're going to go into a couple of examples here. And for the first example, we'll go through the GASB 16 calculation. That'll be the 24 calculation. And then we'll also go through the fiscal year 2025 calculation, but we're going to use the same facts for both. So for this entity, vacation leave in their agreements and their their employee arrangements they have now, vacation leave is paid out at 100% at termination, and sick leave is not paid out at termination. For this entity, they have an unused vacation leave of $600,000 at the end of the fiscal year, and they have unused sick leave of $1.8 million. And then based on historical trends, they've determined that 50% of sick leave is more likely than not to be used. And let me stop here real quick. One thing I failed to mention, we think this is the heavy lifting portion of this new GASB 101 is going to be figuring out your estimate of how much has been paid out historically. Maybe you have that information handy. I'm not sure all entities do. And my recommendation is to start working on that now so that you're not trying to figure it out at the end of fiscal year 25, and possibly right when you get the PBC list from your auditors. All right, so for the fiscal year 24 calculation, that'll be GASB 16, again, using these facts. The vacation portion is paid out 100%, so they currently would accrue this $600,000 for the vacation. The sick portion is not paid out at all at termination, so they don't accrue any of the sick portion. So their current liability would be $600,000. And again, this is only factoring in the probable vesting. I realize this is a very simple example, so I apologize if I know yours is probably more complicated. For GASB 101 now, that changes things. So their vacation portion still, they pay out at 100%. So they're going to accrue $600,000 for the vacation portion. But now, under GASB 101, they also have to take into account their estimate, which we said, based on their historical trends, they determined 50% of sick leave is more likely than not to be used over the life of the employees that are currently hired. So they have to take 50% of that sick portion and accrue that as well. And obviously that creates, for this entity, they had a large sick balance. That creates a much larger liability at the end of fiscal year 25. It brings their liability from $600,000 to $1.5 million, plus whatever their portion of the payroll taxes is, and plus whatever their portion of, again, 401k, 457B style plans might be. The employer portion, not the employee portion. And this is, as opposed to a probable vesting amount, this is a more likely than not vesting amount. And now for our second example, we have another entity that only pays out sick leave when somebody's terminated. And they pay out sick leave at 50% after 5 years of service. Maybe they only offer sick leave, everything's sick leave. Employees over 5 years of service have an unused sick leave balance of $600,000. And employees of under 5 years of service have an unused sick leave balance of $1.8 million, same numbers as before. 45% of their employees are currently under 5 years, and they estimate 45% of those will stay beyond that 5 years based on historical trends. Additionally, they believe 80% of sick leave is more likely than not to be used or paid out based on historical trends. So under the current calculation, you have the vested portion, which is $300,000, and additionally, currently you do have to do an estimated portion for the employees that you believe will stay past 5 years and will be paid out. So that's the 1.8 million times this 45% under 5 years if they believe will stay past 5 years, and take 50% of that as well, and that becomes 405,000, and they're accruing 705,000 for their liability for their compensated absences. Again, this is only factoring in the probable vesting. For the new calculation, that changes. They said, again, we'll go back to our facts. They believe 80% of sick leave is more likely than not to be used or paid out based on historical trends. So this entity decided they were just going to say, this is how much we usually pay out when somebody either leaves or at the end of their tenure, how much they've used. So for the over 5 year employees, they have 600,000, and now 80% of that will be paid out over the life of that employee, 480,000. Under 5 year employees is 1.8 million, and 80% of that will be paid out over the life of those employees. So now our liability balloons to 1.9 million, plus the employer portion of payroll taxes, and plus the 401k 457B portion of defined contribution plans that is owed by the employer. And then this factors in a more likely than not to be used or paid as a termination payment. So as you can see, I mean, I don't know, some people probably are already doing an estimate and calculating more than maybe in my examples. And I realize my examples have, use very simple numbers. So you could be in a pretty good spot here, or you could be looking at this like, oh my gosh, we're going to have huge liability for this. But my recommendation again would be to go ahead and start working on your estimates for GASB 101 now, so that's not a shock. And if it is going to end up being a huge liability, that perhaps you're going ahead and getting in front of that, and you're letting your governing body know about that, giving them a heads up. I'm pulling question number 4. What effect do you believe the changes to compensated absences as outlined in GASB 101 will have on your entity's compensated absences liability accrual? I would be shocked by no increase or decrease even, but I'm sure they're out there. Somebody exists, I'm sure. And as y'all are answering that question, I'm going to move forward. How does the compensated assets information get audited? First, what we're going to need we're going to need a compensated absences roll forward. For fiscal year 24, we need that to include the increases and decreases to the balances. And again, like we said, again, for GASB 101, we're only going to need the net change. We're going to need a listing of compensated absences by employee, your compensated absences policies or any labor agreements that might affect compensated absences, and any of your estimate calculations and determinations. And the way we're going to test this information is, we're going to verify the amounts accrued for sampled employees don't exceed those employees' compensated absences caps as defined by the government's policies and labor agreements. We'll trace amounts used by employees to employee leave requests, and then we will recalculate and review your estimates for reasonableness. And that's going to be a big one for GASB 101 because everyone's going to have new estimates. We're going to be requesting that from everybody. Okay. Looks like some people had a decrease in liability. I fully believe you. I think that was probably the Auburn fan in the group. That's what that was. All right, so moving forward. All right, and that actually brings us to the end of our slide deck. We're maybe a little early here. So if you have any questions, I hope you've been putting those in the question and answer box. I do see
Jamie, we do have a
one.
question in there. It says, deposit bonds payable and retention payable are both very hard to reconcile. Any suggestion on how we should do it?
I think need to provide more of an example. Is this something that Jamie, that we can send an example to Lucy, or?
So, I mean, I would say in terms of how to reconcile your deposits payable and retention payable, I mean, I guess I would need to know the exact situation, but I mean, I think what you need to do is, I think the first thing you need to do is make sure you're keeping track of that information as it becomes available. You know, I agree that if you aren't keeping track with the deposits as they're coming in and the agreements, it might be difficult to then in the back end find those and figure those out. So my recommendation is to make sure that you have the controls in place to make sure that you're capturing those as they're created. Maybe I'm not answering the question exactly.
Well, you got my juices flowing. So I would say actually start with the printout of the GL. So, you know, print a GL detail of the retention account and your deposit accounts. And if it doesn't provide enough detail of who those deposits are for, or the retention, who the retention's from, that's where you want to gather that information from the source documents. And you want to create an Excel spreadsheet to match your general ledger. Okay, so GL is easy to print out, but the departments pretty much take in deposits and refunds out.
Okay,
So,
in that situation, I would say, I mean, there probably needs to be more controls over the deposits that are being taken in. There might need to be more done there on the front end so that you're recognizing which deposits, what the departments are taking in. Maybe even go in there and go through with them what all you need as a department whenever you're coming to the year end, and what kind of information you're going to need so that you can reconcile that and you can be prepared for the audit. Because honestly, if we're not able to tie out the deposits, I mean, you know, that could rise to the level of a finding. So I don't know. I think it might be best. Sounds like it might be a question specifically related to your entity. I would recommend reaching out, you know, and maybe we can discuss that further.
let's see, do we need to accrue fiscal year 24 estimated compensated absences for the employees not vested? We are not obligated to do those. Okay.
I can answer that one. No, for fiscal year 24, it's only the amounts that are probable to be paid out. So you only need to accrue for fiscal year 24 under GASB 16, you know, as you have always done. So it'll just need to be for employees who are guaranteed payouts, or for the amounts that are guaranteed to pay out on termination. I hope that answers your question.
Great. Do we have any more questions? We'll keep it open for maybe just one more minute. But we also wanted to let you guys know that we have another Back to Basics webinar coming up in a couple of weeks. It's going to be on August 27th at 1:30. So you guys can sign up for that right now if you guys want. I just put the Zoom registration in the chat for that. Other than that, thank you guys so much for coming. And if you guys have any other questions, feel free to reach out to Jamie and Monica after this webinar. We'll be sending this recording, the slides and resources, and then the presenter contact information later today. So be on the lookout for that in your inbox. Thank you guys so much for coming.
Thank you.
Thanks, everyone.